Happy New Year. Hello and welcome to another episode of Resource PNG. With 2015 now upon us, we look forward to a more prosperous year. In this episode, we speak with Paul Barker, Executive Director of Papua New Guinea Institute of National Affairs. He speaks on a range of issues affecting the resource sector and offers insight into what can be done to ensure the country's success. Good evening, viewers. Tonight we're joined by the Executive Director of the Institute of National Affairs, Mr. Paul Barker. He'll be speaking to us about the recent fall in oil prices that has affected the global economy, as well as potentially the economy of PNG in 2015. Mr. Barker, thank you so much for joining us.
Thank you.
All right, Mr. Barker, the recent sharp fall in world oil prices, well, they've fallen slightly over 35%. This may impact PNG's revenue in 2015 by some estimates say 1.5 billion. What is your response to that, and what is the stance of INA on this issue?
Thanks. Well, when a government's putting its budget estimates together, they are just forecasts. So in some years, forecasts have been pessimistic. And we've seen, for example, in 2007, 2008, we had what they called windfall revenue, so significant revenue because a whole series of commodity prices were well above forecast, and there was a gain. And during the year, the government actually introduced a mini budget to manage the extra windfall revenue that occurred. In future, that's meant to be handled through the Sovereign Wealth Fund. But obviously, commodity prices go up and they can go down, and the forecasts that were made for the 2015 budget are clearly now rather optimistic. The price of oil and by implication associated energy prices, including LNG, have fallen significantly. This has been happening as a result of global production having been increasing in recent years. It's in effect the result of when prices are really high. When prices are really high, it encourages explorers and production companies and countries as well to really pump in money into new exploration and new development. And also there was concern over risks of supply chains from Russia and from the Middle East. So the United States really put a lot of funds, particularly into fracking, which is this extraction from shale oil from shale using sort of an explosive process. And also you had in North America this tar sands oil coming in Canada. And of course the LNG market really developed, and a lot of new exploration and development around the world, including in this region, in Australia and Papua New Guinea, in LNG. So this was increasing the supply in relation to the demand and having a downward pressure on prices. And then OPEC, which is the cartel, which is the club of particularly Middle Eastern oil producers, they were expected, they were established to a large extent to try and stabilize oil prices for their own revenue. But Saudi Arabia, which is the largest producing country and which is the lowest cost producing country, it produces at less than $10 a barrel. They were clearly keen to knock out a lot of these new developments, particularly in North America. And they could afford to see the price go to a level where they're going to lose out. They miss out on revenue, but they're still making good revenue. But their aim is to try and, in the longer term, push the price back up again. After knocking out all these, some of the new frackers and other developments. So you can, over the next period of time, one might see the price go significantly further down, but the aim, as I say, is really to try and stabilize the price at a higher price, and that will be very much the Middle East and or Saudi Arabia's ambition. So for them and for many producers, a reasonable price, their cost of production for them, as I say, is less than $10 a barrel. For many producers, it's in the range of 50, 60, and some of these newer producers in the range of $70 a barrel. So the aim is clearly to try and get the price. It's slipped down below the $60 a barrel mark now. The aim is in the longer run to get it back up again above the 70, 75, and then to try and keep it steady there. Now, whether that works out is another matter, but in the meantime, we're likely to see the price remain down for the next foreseeable period, for much of 2015, and maybe climbing back up again thereafter. These are oil prices, but energy prices are all linked. You now have biofuel prices, things like palm oil. Their prices are to some extent linked with mineral oil prices, and LNG prices are also linked. They're not completely directly linked, but there is a strong linkage. There is a bit of a separate market, but there is at the moment, again, a bit of a glut. The Japanese, I understand, can't take any more LNG, and it's at the time when the Japanese are also introducing commissioning some of their nuclear power plants. So again, they're not in a desperate need for LNG at this minute. So the best short-term opportunity to give a boost to price would be if there was a very cold winter in China and Japan and they desperately needed extra fuel to power their power stations. But there is this direct link, and clearly this is the big driver of growth for Papua New Guinea in 2014 and into 2015. It was forecast a 22% growth rate. In the budget, it was put down to about 15.5%. It looks likely now to be significantly lower than that. But that isn't too serious in itself, because a growth rate a GDP is just a measure of transactions, of the flow of goods, and it doesn't mean that the benefits remain in the country. So just when you see very high GDP growth rates, it doesn't necessarily mean that there's a major benefit to the country. And if it's a bit lower, that also doesn't necessarily mean, because a lot of the benefits from LNG development do obviously flow offshore to the main shareholders overseas. And at this stage, obviously, a major function is to be paying off the creditors, the banks that provided a lot of the capital for the LNG development. But certainly, the government was envisaging some revenue in 2014 and revenue into 2015 picking up into 2016, 17, 18 as the debts are paid off. They're not really forecasting the revenue to have been flowing in until the middle of the year, because that's the arrangement with the bankers under that basically the owners of the LNG project can't access the revenue effectively until the project has met various criteria and it's been ticked off by the financiers. So really it wasn't expected for the first half of the year, but of course the government's revenue forecasts and expenditure was very much geared to that revenue starting to flow in the second half, and they were trying to negotiate to get release of some of the funds earlier than that in the year to boost cash flow. So yes, it will have an impact on revenue unless, as I say, there's some phenomenally bad winter in the northern hemisphere, and as a result, it would be wiser for the government to be doing its reconsideration of expenditure earlier rather than later, because obviously later the government will already have spent significant portions of the funds, and it becomes less hard to make those sort of reallocations in the budget. So the earlier it's considered, the better, particularly because we're in a slightly risky scenario, because the government has for the last 2 years and is forecast in 2015 to be continuing to be borrowing. So it's very much a debt-financed budget, borrowing from particularly the domestic market, from treasury bills and inscribed stock, but also, of course, there's extra budgetary borrowing that's been occurring as well, including for equity in some major commercial ventures. So these are, when you go, the state doesn't need to buy equity because the state has powers that you and I as investors don't have, so it can tax. So it doesn't effectively need to gamble. It can tax, and tax is a lower risk form of revenue. But nevertheless, the tax revenue will also be affected when commodity prices go down and revenue falls and profitability falls on projects. So by having a budget that was substantially dependent on borrowing, plus this arrangement of $2.5 billion coming in from sale of equity to landowners, I'm not sure how that's meant to be managed. Presumably it's still going to be dependent on some loan guarantee, maybe through MRDC. But these add risk factors, and obviously the crucial aspect of and functions of a government are to provide basic and reliable goods and services. So it will be important for the government to ensure that those critical law and order, health, education, etc., infrastructure, maintenance, etc., that these are not jeopardized.
You're watching Resource PNG. Don't go away. We'll continue our discussion with Paul Barker right after these messages. Welcome back to Resource PNG. Towards the end of 2014, global commodity prices took a tumble, affecting economies right around the world. And with Papua New Guinea heavily dependent on income from the mining and petroleum sector, the current price drops could have a massive impact on revenue in 2015. Here is what INA Executive Director Paul Barker has to say on what can be done to soften the impact of the current price drops.
It's always prudent for a government to be risk conscious and to be conservative when it comes to budgeting. And that's conservative with a small c, not politically conservative. There's nothing wrong with some level of public borrowing, and particularly after the winding down of the construction phase of PNG and LNG, there was going to be a lot of downturn in economic activity, and quite a lot of jobs were going to be cease to exist. So it was important for the government to try and maintain the stimulus, and so a fiscal stimulus provided by the government, including from borrowing, was quite a reasonable activity. It was then important that it's kept within a sensible level, and it's really prioritized into those core functions which are going to be valuable investments for the country's future. Obviously that means core infrastructure, particularly ensuring access to markets for agricultural producers all around the country, the good main roads, that the main roads can access the ports, good ports. So yes, it's certainly sensible to be investing in Lae Port, which is the biggest port in the Pacific outside Australia and New Zealand, but was a real bottleneck for. So that was a sound investment, but also you need the investment in law and order, because that is one of the major impediments to business and to livelihoods. But you need investment also into schools and education. Again, the government is putting money into education. That's a priority, but we need to make sure that the quality of education is enhanced. You can't just fill up the classrooms and then not have the kids actually learning or becoming literate. You need to build up the number of teachers and make sure that the teachers' skill level is such that they can handle, that you don't end up with classes of 90. So these are critical, and clearly the health services are crucial as well, in that they have deteriorated over the last decade, according to a recent study by ANU and NRI, and also over the previous years they've also been tending to deteriorate. So that's another crucial investment, and particularly again it's got to be for people in the urban areas, but also people in the rural areas. There's been a major concentration in the last few years on major infrastructure projects, including sports facilities in the national capital. But if you look out and around the country, you'll find a large portion of the population has absolutely no access even to the basic health services, schooling, access to markets. It's like there's a large slice of the population that is almost cut off from being part of a growing economy and the state of Papua New Guinea. And really a foremost attention needs to be given to them, and including their capacity to contribute, not for their own, just for their own livelihoods, but for their contribution to the PNG economy as a whole. Clearly the government has put money into the districts, but the problem with the district grants is that there's very little in the way of planning and management capacity at the district level, and the mechanism is an unaccountable mechanism by and large. And we know from recent reviews that very large sums of money have been misappropriated or misapplied, certainly haven't been following due process, and again it's funds that we can't afford to be wasting. We know that the mechanism is a rather politicised mechanism. That's in some districts, the members of parliament and their district officials have managed the funds reasonably well and on sound investments, but in many other cases that's not the case. So again, one needs to be spending where the money can be most effectively used, and we certainly need to address the areas of public procurement, because quite clearly we've seen a lot of supply and tender processes where the winning bid seems to have been the highest or the second highest proposal rather than a cheaper one. And so it would appear that very large sums of money have been wasted in that regard, and various projects have gone without even any tender process at all. So again, these are sort of wastage. But one would have to say that some of these grand projects do look like white elephant projects, that they're not priorities in terms of creating long-term sustainable economic activities and long-term investment in human resource development.
You're watching Resource PNG. We'll be back with more after these messages. Welcome back. In mid-2014, the Central Bank of Papua New Guinea made a decision to impose foreign exchange trading margins on the kina against the US dollar. This impacted on revenues received from the resource sector. In this segment, INA Executive Director Paul Barker discusses the impact that this trading ban can have on the resource sector and the economy of the country as a whole. Just to the value of the kina, how long do you think the central bank should intervene in having the kina at one particular point? How long do you think this will last?
Well, the central bank's basic function is to keep the inflation level in check, and it is also to manage other aspects of monetary policy, including trying to keep a reasonably stable exchange rate and reasonably stable interest rates, to try and facilitate fund availability for credit and so on and so forth. But it's to manage it in a reasonably stable manner and consistent manner, and to cause or to see major jumps or artificially, or what appears to be artificially pegging the exchange rate at a level which appears to be above the market rate is clearly going against the grain, and it means that it tends to result in a draining of those foreign exchange reserves, and those reserves then become progressively less in terms of coverage for trade purposes, and clearly trading companies have been squeezed when they've been trying to get, for example, 100,000 transaction, and they're told they can only get a 50,000 transaction. Clearly at some stage they've got to pay for the goods and services that they've already committed to, so it influences their business credibility. So really the government has to, or the central bank has to make sure that the market, yes, they can see at times that there are aberrations in the market. They may perceive that the banks are making too much on foreign exchange transactions, on the spread. Whether that's true or not, the banks certainly argue it's not, but the central bank argues that that's the case. But in any case, it did appear that the major factor seemed to be this adjustment. Yes, they may be forecasting a return to a greater inflows of foreign currency over the next months, and that they're trying to shake it back to a stronger level in advance. But there's a limit to how far you can go against the grain, and it's certainly costing credibility to businesses. And there are other ways also of obviously determining the levels of foreign exchange transactions and so on. But at the moment, by having a stronger currency, it actually effectively encourages imports, undermines to some extent the competitiveness of local producers of fruit and vegetables, and as well as the export crops. So, and at the end of the day, as with the new government, as the government's new sustainable development strategy does emphasize the need for diversification of the economy, it's critical that that the costs of production across the board are minimized for all businesses, and that the viability, including the price for sale of those other commodities, is strong, and there's a good incentive for agricultural producers and other businesses to invest and to rehabilitate and develop their crops and industries.
You mentioned the strategy on responsible sustainable development. A big part of that is the focus on renewable resources, such as in agriculture and fisheries and all that. Do you think enough emphasis has been placed on that in the 2015 budget to reflect the government's views?
There's not a lot of direct financing going to agriculture in the budget, but admittedly the institutions of government that are responsible for agriculture are in a bit of disarray. Many of them are pretty poorly managed. Most of the commodity boards haven't got legitimate boards that have been appointed, and these boards are meant to be representing the farmers themselves. So the farmers are going to have and the industries themselves are going to have a pretty good idea, or the best idea probably, what's best for their industries, rather than some of the bureaucrats and even some of the ministers in Waigani. So there really needs to be a lot more reflection of what the industry actually needs, and then when mechanisms are put in place to support the sector, including the use of public funds, it's important that the government avoids mechanisms like the NADP in the past, where the funds effectively became a political slush fund and really resulted in little or no additional agricultural output, because there were some quite good proposals that were submitted, but many of the good proposals, or most of the good proposals, seemed to be ignored, and very much the more political proposals and one-talk proposals were the ones that actually got financed. So agriculture needs to be taken a lot more seriously. It's always given lip service. Successive governments have stated it's a core priority, and as you say, it's a core priority in that sustainable development strategy. But nevertheless, when it comes down to it, the actual actions by government, including the finance that's made available to the sector, is not such that's really going to get the industry going.
And that's all we have time for on this edition of Resource PNG. If you want to know more about the program, please email us. Our address, resourcepng@mtv.com.pg. You can also view this edition online by going to www.mtv.com.pg, where you will find a link to the Resource PNG page. Until the next time, I'm Meribatulo, and this has been Resource PNG.